Hello, today is June the 16th, 2022, and it's time for a new stock pick video and market commentary. As always, I'll start by reviewing the performance of the picks I had this time last year. And I recommended Meta Financial Group, which was down 28.8% since this time last year. Dollar General, which was up 13.7% since this time last year, including dividends. And Kirkland Gold, which later merged with Agnico Eagle Mines in February of this year. The combination of holding Kirkland and then Agnico Eagle over the last year would have resulted in a return of negative 7.9%. And the average of these three was negative 7.7%, which compares to minus 12.2% for the world markets, as represented by the URTH ETF in US dollars, including dividends. So going forward, and where we are now, it's a highly unusual situation. We haven't experienced anything like it, I think, since probably the 80s, in that we have inflation, the higher inflation that we haven't seen since the beginning of 80s, and rising interest rates. Now, there's speculation that we're going to have a recession. I'm going to comment on this and what happens during those times, and the possibility of stagflation, where we have higher prices and slow growth. Now, my view on the possibility of a recession is that it is likely. It's quite likely, actually, and the reason is probably not the Fed raising rates, even though it's going to be, and other central banks, that's going to be the immediate explanation that everybody will have. A simpler explanation may be that world output, as measured by GDP, is a function of energy consumed. It takes more energy to make more stuff. It's as simple as that. The work that I've done looking into the world GDP numbers and the total world energy consumption from primary sources indicates that energy consumption is able to explain and predict GDP almost with 100% accuracy. It is eerily accurate. So GDP will equal an energy consumption coefficient that measures the efficiency of our ability to convert energy into things, times the energy that we actually use. And while the energy efficiency over time improves because we're getting better at making more stuff using less energy. Think, for example, LED light bulbs using less energy than the old incandescent bulbs and so on. We still need more energy, and we've had a massive underinvestment in the energy, especially the conventional oil and gas business over the last 15 years, and especially during 2020, during the lockdowns and so on, because the price of oil worldwide had dropped to really, really low levels, and companies slashed their investment expenditure to next to nothing. So money that's being invested now in the sector will take 4 to 6 years before it results in increased oil and gas production. and it's not easy to replace the energy growth that's being lost from these conventional sources by the renewable sources, even things like nuclear, because even those things take a long time to bring to market. So, world population is growing. Our energy production is not able to keep up with the demand growth. So there is a decent chance that we're going to be in a recession for the next year, 2 years, until we get more energy from all sources to satisfy the needs of the world economy. Now, with that in the back of the mind, and with rising rates in the back of our minds as well, so we're going to look into stocks. But I have to say that for the first time in almost 14 years, I think now, we are adding GACs into client portfolios, because we are getting rates around 4.5%, which we haven't seen in a very long time. But this is a stock pick video, so I'm going to concentrate on the stocks. But that was as an aside. So for stocks, given the uncertain environment that we are in, my thinking now is to concentrate on quality and concentrate on larger cap companies, bigger companies, because they're likely to do better in an uncertain environment than smaller companies. And also look at companies that pay dividends. Ideally, a dividend yield of over 3.3%, which is the current yield on the 10-year note. And companies whose stocks are trading at reasonable valuations, and they have an ability to grow as well. They don't pay all the earnings out in dividends, so the payout ratio of less than 60% or so. One such good example, I believe, is Verizon Communications, the largest cell carrier in the world. I think it has a very good dividend yield, around 5.2%. Payout ratio is around 50%. Valuation is reasonable. So that would make a good place to have some money. A second pick would be one that's an inflation hedge in case we are continuing to see inflation going forward. Is thinking about the 70s and what happened in the 70s when we had possibly similar conditions as we do now. Stocks did okay, but the majority of the return came from dividends. That's thing number one. More than 50% of total return came from dividends. And another factor to consider was that energy was about the only sector that did well during that time, really well. Precious metals as well, but precious metals were very undervalued back then, and they're probably not undervalued now. Yeah. So with that in mind, an energy stock, a large cap energy stock, makes sense, and I picked Devon Energy Corp. With Devon, we have everything that I talked about with what we need with regards to entering this kind of environment. A dividend yield of 5.3%, an inflation hedge, hopefully a decent valuation, but that remains to be seen, because if we go into a recession and there's demand destruction, perhaps energy companies will not do as well, but the future is always uncertain, and it's good to be well diversified. So I have one energy stock pick, and we also have a tech stock as well, if things are not as bad as most people anticipate. Technology companies should do reasonably well, and Here we stuck with quality, Cisco Systems. Cisco was one of the darlings of the 1990s, and since then it's been more of a mature business, and now the valuation is reasonable. He also pays a dividend of 3.4%. So it has the quality, it has the scale, it has the ability to withstand the recession, we hope. So that's that kind of technology company that we feel comfortable owning. Now, having said that, if things don't go as badly as anticipated, the more growthier technology companies will do better. But this is probably not the time to be chasing the high growth names. So if you'd like a second opinion as to what your portfolio looks like, or whether these stocks fit in your portfolio, or any other matter regarding your investment portfolio, don't hesitate to give us a call. Thank you. Have a great day.